Welcome back to the Deep Dive. Today is Friday, January 23, 2026. And if you have been glued to the ticker this morning, you already know.
Oh, yeah.
The board is just lit up. It is a massive earnings day. We aren't just looking at a few tech flyers today. We're looking at, a stack of reports that feels heavy. Literally and metaphorically heavy.
It really is. We're calling this the Iron Financial Deep Dive for a reason. These are not your typical hype cycle stories.
No.
We are looking at the absolute backbone of the economy. The heavy machinery pulling energy out of the ground, the contractors keeping the Pentagon running, the networks, and of course the banks holding the capital.
It's the plumbing, the wiring, all of it.
Yeah.
And honestly, the theme that's emerging already is. It's surprising. You usually think of these old economy sectors as, slow, steady.
A little boring, maybe.
Yeah, a little boring. But looking at the numbers from SLB, Booz Allen, Ericsson, and the banks, boring is the last word I'd use.
Not at all. We are seeing pivots that would make a Silicon Valley startup jealous. We're seeing resilience in the face of that government shutdown that, paralyzed Washington. And we are seeing banks that have finally fully digested the crises of the last few years.
Okay, so we have a lot to get through. We're going to start in the oil patch, or what we used to call just the oil patch with SLB.
Right.
Then we're heading to D.C. to dissect Booz Allen Hamilton. After that, we'll hop across the ocean for Ericsson's recovery, and then wrap it all up with the money. First Citizens and Webster Financial.
It's a roadmap of resilience. It really is.
Let's start with the heavy hitter then. SLB, formerly Schlumberger. They just dropped their Q4 and full-year results. So for the listener who hasn't seen the ticker yet, give us the headline. Is the energy supercycle still alive?
It is very much alive, but it's maturing. SLB posted Q4 revenue of $9.75 billion.
Correct.
That's up 5% year over year, and maybe more importantly, up 9% sequentially from Q3. They brought in Jeep earnings per share of 55 cents.
Okay, so let's unpack that. 5% year over year, that's solid, but it isn't exactly, setting the world on fire compared to some other sectors.
Yeah.
Is the market reacting to that top line, or is there something else going on?
The market is reacting to the confidence. You have to look at what they're doing with their cash. This isn't a company that's scared of the future. SLB approved a 3.5% increase in their dividend. But the real candy here, the thing that institutional investors are circling today, is the capital allocation plan for 2026.
What are they planning?
So CEO Olivier Lepouche came right out and stated they are committed to returning more than $4 billion to shareholders in 2026. That's through dividends and share buybacks.
$4 billion. That's a massive number. That's not a, we hope to do well. That's a, we know the cash is coming.
Exactly. It signals that their cash flow is robust and, crucially, predictable. They aren't hoarding cash. They're distributing it. That tells you everything about their internal confidence.
Now, we have to talk about the integration. SLB made that huge play acquiring ChampionX. And usually, these big mergers, they can be messy. They can drag on earnings. Is that what we're seeing here?
Quite the opposite. It seems to be fully integrated, and it's definitely driving the numbers. In Q4 alone, the ChampionX businesses contributed $879 million in revenue.
Wow, so that's a big chunk of that $9.75 billion total.
A very significant chunk, and it is pulling its weight.
Okay.
Lepouche specifically mentioned it's delivering accretive margins. So in plain English, the new business is actually more profitable than some of the old business. It's lifting the average.
That is the holy grail of M&A. But here's where it gets really interesting, and this is the part of the report that made me put down my coffee. We think of SLB as the drill bits, the subsea robots. But there is a line item here for data center solutions.
Yes, and this is the aha moment for this earnings season. SLB is an energy giant, yes, but they are quietly becoming a huge player in tech infrastructure. Their data center solutions business grew, get this, 121% year on year.
Wait, hold on. 121%? For an oil services company.
Correct. It generated $460 million in revenue for the full year. Now, context is key. That's still a small piece of their total revenue. But the growth rate is just explosive. The CEO said explicitly he expects this to be their fastest growing business for years to come.
So help me understand. Why is an oil company building data centers? What is the synergy here?
It's all about the physics of heat. Think about what SLB has been doing for 100 years. They manage complex fluids and machinery in the most hostile environments on Earth.
Right. Miles underground, extreme pressure.
Exactly. They are masters of industrial cooling. And now you look at a modern AI data center. What is it?
It's basically a furnace.
It's a furnace. The hyperscalers are hitting a wall. They can't cool their servers with traditional air conditioning anymore. They need liquid cooling. So SLB is saying, hey, we've been doing this in oil wells for decades. We can do it for your server racks.
That is brilliant. So it's an oil company saving the internet from overheating.
Pretty much. They're manufacturing modular data center enclosures, cooling systems. They expect to exit 2026 with a quarterly revenue run rate of $1 billion a year for this business.
$1 billion a year. So that is no longer a side project.
No, that is a major growth engine.
Wild. Okay, before we leave SLB, what about their traditional business? The Middle East, the oil cycle. What's the outlook?
The CEO is very clear. He believes the headwinds of 2025 are in the rearview mirror. He specifically mentioned the recovery of Saudi Arabia, expecting rig counts there to rise. And they're very bullish on offshore. They're expecting over $9 billion in subsea bookings in the next 2 years.
So the message is, the oil patch is recovering, Saudi's back, and oh, by the way, we're also a high-growth tech stock now.
But that's a pretty fair summary. It's a pivot to watch.
All right, let's pivot ourselves. From the oil fields to the swamp, Washington, D.C., we have earnings from Booz Allen Hamilton. This is their Q3 for fiscal year 26. And looking at the top line, ouch.
It does look painful at first glance. Revenue dropped 10.2% year over year to $2.6 billion. For a company like Booz Allen, that's startling.
So what happened? Did they lose a big contract?
Neither, actually. This is a classic case of macro headwinds. You have to remember what late 2025 was like.
Right. The government shutdown. I think we all tried to block that out.
No, it was a month and a half long. And on top of that, you just had a slowed procurement environment.
It's hard to get paid when your main client, Uncle Sam, closes the office doors.
Exactly. The shutdown drove a decrease in headcount, a decline in billable expenses. You can't bill for work you're not allowed to do.
But here's the twist. Revenue crashed. But, am I reading this right? Their net income actually went up.
It did. Net income rose 7% to $200 million, and adjusted EBITDA came in at $270 million.
How do you lose 10% of your sales and make 7% more profit? That seems, I don't know, impossible.
It's what they call disciplined execution. They manage costs incredibly aggressively. When that revenue spigot turned off, management just clamped down on everything.
So they proved they can stay profitable even when the lights go out. But what about now that the government is back open?
That brings us to the most important number in their report, the backlog. They reported a record Q3 backlog of $38 billion.
Up 2%.
Up 2%. So the work is there, the contracts are signed, they just need the funding to actually flow.
So the thesis is that the revenue drop was a political glitch, not a business failure.
Exactly. And they're not just sitting on their hands. They mention a new partnership with the venture capital firm A16's and Andreessen Horowitz.
Oh, interesting. A defense contractor teaming up with Silicon Valley VC.
It signals a real push into cutting-edge defense tech. So despite the shutdown blues, they are absolutely playing the long game.
Fascinating stuff. Okay, let's cross the Atlantic now and talk about Ericsson.
Yeah.
The telecom giant. We've got their Q4 numbers.
We do. Ericsson reported Q4 sales of 69.3 billion Swedish krona. Now, the headline says sales are down 5%.
Down 5%. Another drop. Is this that telecom winter we keep hearing about?
Not exactly. You have to look at the nuance here. Reported sales are down, but their organic sales, they're actually up 6%.
Okay, remind everyone, what's the difference between reported and organic?
Organic strips out things like currency swings and, more importantly here, divestments. Ericsson sold off a business unit called iConnective. When you sell a business, you lose its revenue, so the whole pie looks smaller.
Got it. And that hit their enterprise segment pretty hard, right? Down 25%.
Exactly. But if you strip that sale out, the core engine is humming. Their cloud software and services segment is flying. It was up 12% organically.
And what's driving that?
It's the shift from building 5G to managing 5G. The telcos are looking for software to manage their networks now. Ericsson is capitalizing on that.
And software usually means better margins.
It does, and you see that here. Their gross margin improved to 47.2%. They're just doing more with less. It's a theme this season.
Efficiency seems to be the word of the day. Booz Allen, Ericsson.
It is. It's a sign of mature management. When growth gets tough, you look inward and you optimize.
Speaking of optimizing and strengthening foundations, let's talk banks. We have two interesting reports here. Let's start with First Citizens, ticker FCNCA.
Yeah. First Citizens has been such a great story since they acquired Silicon Valley Bank, and this quarter really feels like a victory lap for them. Net income of $580 million and a huge EPS of $45.81.
Those are big numbers.
Yeah.
But there was one line item that really stood out to me, something I'd call a freedom moment for them.
I think I know what you're talking about. The repayment of that FDIC purchase money note.
That's the one, $2.5 billion, right?
Yes. They paid it back in full. It cleans up the balance sheet completely. It removes that tether to the FDIC. And it signals they have fully digested that massive SVB acquisition.
It's like paying off your mortgage. You own the house free and clear.
Pretty much. And they're feeling confident, so they're returning cash. They bought back $900 million in stock.
That is aggressive. What about the actual banking business? Are they growing loans?
They are. Loans grew 2.2%. But what's really fascinating is where that growth came from.
Right.
It was led by global fund banking.
Huh. That's the old SVB business, lending to venture capital and private equity.
It is, and that's a huge signal. If they're lending more to VC funds, it means those funds are active again. It shows that the innovation economy is waking up.
Interesting. Okay, so First Citizens is cleaning house and growing. Let's look at Webster Financial, ticker WBAS. They're celebrating a birthday.
They are. It's their 90th anniversary year, and they celebrated by hitting a record tangible book value per share.
Happy birthday to them. So for listeners, why does tangible book value matter so much for a bank?
It's basically the liquidation value of the bank. Growing that over time is the truest measure of value creation. It's your safety floor.
And how did their quarter look?
Solid. EPS of $1.55 on revenue of $746 million. But what stands out is their net interest margin, or NU, came in at 3.35%.
In this rate environment, that's pretty healthy.
It's a very healthy spread, and I noticed their loan growth was actually a little bit stronger than First Citizens.
Oh, really?
Yeah, just slightly. Loans were up 2.8% to $56.6 billion.
Which brings up an interesting contrast. We just heard Booz Allen say government procurement slowed down, but Webster is saying regional bank lending is ticking up.
It really highlights the divergent economies we are in. The government sector was paralyzed. But the private sector, the businesses Webster lends to, kept moving, kept borrowing. You can't just look at one macro indicator.
So what does this all mean for you, the investor? We've covered a lot: oil, data centers, defense, telecom, banking. What is the synthesis here?
I think there are three main threads to pull on today.
Give me the first one.
First is resilience versus headwinds. Look at Booz Allen. Their customer literally shut down. Revenue tanked. But they grew profits. That is resilience.
It's the iron financial theme, bending, not breaking.
Exactly. The second thread is shareholder returns. We're seeing massive cash returns. SLB's $4 billion promise. First Citizens buying back $900 million. They are generating cash, and they are giving it back.
And balance sheet optimization seems to be the strategy of the year.
It is. And the third thread is the pivot. And this brings us right back to SLB. We are seeing old school industries finding brand new growth engines.
The oil services company becoming a data center play. That's the one that really sticks with me.
It shows you just can't categorize companies based on what they did 10 years ago. You have to look at where they're putting capital today.
Which leads me to a final thought for you to chew on. We often talk about tech and energy as two separate buckets. But if SLB is telling us that data centers are their fastest growing business, are we looking at energy stocks the wrong way?
It's an important question. Is energy infrastructure becoming tech infrastructure? In 2026, you can't run AI without massive power and massive cooling. The lines are blurring.
Something to think about. Maybe the future of tech is drilling for oil, or at least using the same pipes.
It just might be.
Thanks for joining us on this deep dive. Keep analyzing, and we will see you next time.